Chapter 1. Retirement and Mr. Market. Mr. Market's job is to provide you with prices. Your job is to decide whether it is to your advantage to act on them. You do not have to trade with him just because he constantly begs you to. Benjamin Graham. One day, you're going to get tired of working. However, your bills aren't going to get tired of being paid. So how do you make money when you aren't working? Most people will work 40 years to build up a nest egg. Once they retire, they start taking money out of their accounts to pay bills. The question becomes, how much can I spend each year and not run out of money? Most investment advisors recommend that you sell 4% of your nest egg each year to fund expenses and increase that withdrawal rate over time to keep up with inflation. Let's follow a hypothetical couple named Jim and Sally to illustrate how it works. The typical retirement plan. Jim and Sally have worked their entire lives. They are now ready to kick back, relax, and enjoy time with their kids and grandkids. They have saved up for years and have built up a $500,000 portfolio. Both turned 62 this year and will soon be collecting $3,000 per month in Social Security benefits. Jim and Sally spend $50,000 per year. Social Security covers more than half of their spending, but they are still $20,000 short. Without a paycheck, their investment accounts will have to cover the difference. Jim and Sally meet with a financial advisor to discuss their options. He tells them stocks return an average of 9% per year, so that's what they can expect in the future. He tells them that they can take out 4% of their account value, which is $20,000, and never run out of money. A 9% return on a $500,000 account would be $45,000 per year. As long as they take out $20,000 per year or less, they will still have at least $25,000 left over to reinvest in their account. Over time, their account will still grow, and they'll be able to take out even more money. In theory, this makes a lot of sense. As long as their portfolio grows by 9% per year, Jim and Sally have nothing to worry about. Unfortunately, Jim and Sally haven't met Mr. Market. Who is Mr. Market? Legendary investor Ben Graham introduces Mr. Market in his book, The Intelligent Investor. Mr. Market is the person on the other end of your stock market trades. Mr. Market wants to buy your shares of stock every day. He quotes you a price at which he will buy your shares of stock or sell you some of his. The problem is Mr. Market is a manic depressive. When he's in a good mood, Mr. Market is willing to pay you high prices for your stocks. When he's in a bad mood, he doesn't offer much. His mood fluctuates wildly from day to day, week to week, and month to month. Mr. Market might be willing to pay you $40 for his shares of Coca-Cola on Monday and $45 on Tuesday. A few months later, he might not even pay $25 for your shares. You don't have to take Mr. Market up on his offers, but he will always quote you a price, every single day. It's easy to ignore Mr. Market's price quotes when you are buying shares. As Jim and Sally added to their investments, they bought from Mr. Market whether prices went up or down. Things get more difficult when you start relying on Mr. Market's mood to pay your bills. Jim and Sally now have to start selling $20,000 worth of their stocks back to Mr. Market each year. If he has a bad day, they will have to take him up on his offer to buy their shares, even if it's at a low price. Let's see how the 4% strategy works out for them using actual market returns from 1999 through 2015. Year number 1. In the first year of their retirement, Jim and Sally run into a bad year in the market. Mr. Market's in a bad mood, and their mutual funds are down by 9%. After taking out $20,000 to pay expenses, Jim and Sally's portfolio has dropped below $435,000. Jim is particularly concerned and asks their advisor if they've made a mistake. Will he have to go back to work? Their advisor assures them that markets go up and down. This down period is a speed bump. Stock prices will come back over time. Year number 2. Mr. Market continues to be in a foul mood in year number 2. Jim and Sally's accounts are down another 11.8%, or minus $51,000. On top of that, they took another $20,000 out to pay bills. Their account balance at year end falls below $363,000. Was investing in stocks the right thing to do? Should they even be in the market at all? Their advisor assures them that the market will come back. Hold tight, he tells them. To be safe, their advisor recommends they reduce their withdrawals from $20,000 to $14,500 per year. Unfortunately, Jim and Sally can't do that. Sally has to have another surgery this spring, so they will need the entire $20,000. Year number 3. Unfortunately, Mr. Market's bad mood continues into the 3rd year. The market is down by a whopping 22%, and Jim and Sally's portfolio continues to plummet. By the end of year 3, Jim and Sally's account is worth $261,813. That's down nearly 50% from when they started. Jim and Sally are terrified. They thought their nest egg would get them through retirement. Mr. Market had other ideas. Instead of living a comfortable retirement, Jim and Sally might have to go back to work. What now? Most people cannot watch their nest egg fall by 50% and remain committed to their original plan. The emotional toll is too enormous. Jim and Sally go to their advisor and demand that he sell their shares and move to cash. Jim and Sally lock in their severe losses and miss out on the future stock market recovery. As a result, they end up running out of money in 10 years. If Jim and Sally had kept with their investment plan, their money would have lasted much longer. Unfortunately, the damage to their account was already done. Even if they had stuck with their original plan, Jim and Sally would have run out of money by age 86. Jim and Sally would invest a little differently if they had a second chance. They might have chosen something safer than the stock market and Moody Mr. Market. Why not stick with safe bonds? If they could go back in time, Jim and Sally might explain to their investment advisors that stocks are too risky. Why should we own stocks at all? They are too volatile, Jim declares. We need something safe. Their advisor recommends investing in a portfolio of 100% bonds. The advisor explains that when you buy a bond, you lend money to a company or government. In exchange, the borrower agrees to pay you interest and pay you back one day. For example, a 10-year U.S. Treasury bond has an interest rate of 2.5%. If you bought $10,000 worth of this bond, you would collect $250 per year in interest. When the 10 years are up, you get your original $10,000 back. Bonds are considered safer than stocks because you know what return you will get whenever you buy it. As long as the borrower can afford to pay you back, you'll always make a positive return. Mr. Market quotes a new price every day, but he's not quite as manic-depressive with bonds as he is with stocks. His quote generally stays around the same value. Jim and Sally's advisor finds them a bucket of corporate bonds paying 4% per year in interest. Perfect, right? With their $500,000 portfolio, these bonds will pay $20,000 per year in interest. That is exactly what they need to cover their spending. Now they don't have to worry about the stock market at all. Since Jim and Sally no longer own stocks, Mr. Market's manic-depressive mood swings are of no concern to them. They love their advisor's new plan. A 100% bond portfolio is surely the way to go, right? The silent killer of all retirement plans. Unfortunately, there's a problem with Jim and Sally's all-bond portfolio. It's called inflation. Jim and Sally's expenses will continue to increase each year as the prices at the grocery store go up. On average, inflation runs about 3%. So a $1 bill today will be able to purchase about 97 cents worth of groceries next year. Then 94 cents the year after that. Over the next 25 years, every dollar in your pocket will buy 50 cents worth of stuff. If your grocery bill is $400 per month today, it will be $800 per month in 25 years. That means Jim and Sally have to keep taking more and more out of their account each year to keep up with rising costs. Jim and Sally are earning $20,000 per year in interest. Unfortunately, this income stays constant. Their portfolio may be producing $20,000 per year, but they end up taking more each year as their expenses grow. While their spending goes up, their income does not. To make up for it, Jim and Sally have to start selling chunks of their bonds to pay their growing bills. Their expenses increase faster than the bond interest produce. Jim and Sally have to sell a few bonds each year to cover the difference. This does severe damage to their account because the bonds they sold don't pay interest. So next year, they will earn less than $20,000, and they will need to take out even more than $20,000 to pay their bills. The destruction of their portfolio snowballs over time. They need to sell more bonds to cover more expenses. The more bonds they sell, however, the less interest is there the next year. Jim and Sally will eventually run out of bonds to sell. As their bonds get sold, the interest payments go away. The cycle repeats itself until Jim and Sally either run out of money or have to lower their spending. What about annuities? Fortunately, Jim and Sally still have their time machine. They would go back in time and tell their advisor that stocks are too risky and bonds don't keep up with inflation. They ask him, "What else is there?" He tells them about a financial product called an annuity. The advisor likes annuities because he makes a huge commission from them. For every annuity he sells, the advisor can make 4% to 7%. If he sells an equity index annuity, he can make between 5% and 12%. What a deal, for the advisor, that is. The annuity is an easy sale. Jim and Sally's advisor tells them that the payments are guaranteed income for life. If the stock market goes down, your account won't go down with it. What a great solution. Unfortunately, annuities don't solve any of Jim and Sally's problems. In fact, they make them worse. Here's why. Annuities have the same problem that bonds have. Their income is fixed. While the cost of groceries is going up, your annuity check is the same year after year. Some insurance policies come with an inflation rider that increase payment with inflation. Unfortunately, you pay for the inflation protection by taking lower initial payments. Plus, when you buy an annuity, that money is gone. People are afraid of stocks because they don't want their $500,000 to fall to $250,000. So they buy an annuity to protect themselves against market declines. That's ironic. When you buy an annuity, your $500,000 goes to zero. All that money goes to the insurance company. You still get the payments, but your original principal is gone. Do you know what happens with that $500,000 check Jim and Sally mailed to the insurance company? The insurance company invests it into stocks and bonds. So you were afraid to invest the $500,000 in the markets, so you paid the insurance company to do it for you. Why not save the high fees and commission checks and invest it yourself? Furthermore, annuity income is quote-unquote guaranteed, but that may not be as great as it sounds. If the insurance company goes out of business, what do you think happens to your annuity checks? If there is no insurance company left to pay your annuity payments, they go away. That $500,000 would vanish into thin air. If you're thinking about buying an annuity, make sure you understand all the terms first. Also, make sure you know how much your so-called advisor is going to make on them. In most cases, the fees, commissions, and the 2,000-page document should be enough to steer you away.